Okay, so what are you saying, people, and welcome back to your favorite YouTube channel. So today, guys, we'll be discussing how to trade choppy markets. Now, I'll be walking through a few examples. I do have some diagrams to talk you through about what we expect to see, how we can trade them, how we can take advantage of certain patterns in these choppy markets. I do have some examples on pound entity and euro AUD coming up. So if you guys are interested, feel free to stick around. Make sure you do like the video, subscribe if you haven't done already. Without further ado, let's get into the video. Okay guys, so welcome to the chart. So as you can see, I've got two diagrams here, two examples, one on the left, one on the right. On the left is the textbook, generic, easy to understand, sideways moving market. You can see equal highs there, equal lows, you know, very symmetrical, easy to understand. However, on the real life markets, when you get to, you know, looking at your generic Forex pairs, things look a little bit different. They're not always as clean, not always as symmetrical. You can see here, this is a bit more of an accurate representation of what we actually see in the live markets. You can see that the highs are not very, you know, at the same exact price. Sometimes they come a little bit higher, sometimes a little bit lower. And we've got a lot of minor swings, minor lower highs within the range as well. And this is more of an accurate representation of what real life markets, real life choppy markets look like. Now we can simplify this and form a very easy strategy to trade these, because again, a lot of people do get lost in these little swings here, and that's normally where they lose all their money. But today I want to show you how we can avoid that and just focus on specific areas to take advantage of these choppy conditions. So onto this diagram here. So as you can see, you've got the high of the range, low of the range. This is the high of the range and this is the low of the range. Now this is where we're going to be focusing our efforts in the market. We don't really care what's going on in these areas. You know, you don't want to be focusing on that. That has this area here within the range has the most uncertainty where the price could go next. Sometimes the market will come into this area, just continue up, or continue back down. It might range a little bit, might fade to go up, it might go 3/4 of the way up and come back down again. You don't really want to be focusing your efforts in there. You can do if you want to, but in terms of probability and getting a good trade, the high of the range and the low of the range is where you're going to be focusing that your efforts at. So when you're coming onto your charts and you see a choppy market, first thing you want to do is map out the extremes, the high of the range and the low of the range, like I've done so here. And again, you want to do that using a rectangular tool, use a zone, because it's not always a specific line. Normally it's a zone, so you use a rectangle tool to represent that. And the second thing you want to do is wait for fake outs. This gives us a very high probable trade, because sometimes the market, yes, will come to the high of the range, respect it, and come straight back down again. Those are, you know, very nice trades which everyone can spot. But sometimes the market, actually not sometimes, quite often the market, especially in choppy conditions, will have fake outs like these moves here. Above the range, goes slightly above or slightly below, and this will again catch a lot of people out. Stop losses will be underneath this level. A lot of people will be ready to catch the breakouts, catching people on the wrong side. It will snap back in, and then you see the move go in the opposite direction. These patterns here, these moves are very powerful because they have a high probability. Reason being, they're catching out a lot of people on the wrong side. And then after they catch people out and grab liquidity, that's when we can enter the market. You know, after the fake out is done, now we've got clarity in which direction price could go next. And the key thing you want to be watching after the fake out is just the retest after. So that's how we enter our trades. You don't necessarily look for the fake out and enter straight away. Wait for the fake out to happen, wait for the market to come back inside the range, the retest, and then we take our sells. Let me just change the color of that so it's a bit more obvious. So these are where we take our sells from the high of the range, and this is where we take our buys. And again, sometimes the market will give you multiple opportunities to enter, because again, it's a choppy market. It's going to have a lot of fluctuation. And all the time, it's just going to be a fake out, retest, and move. Sometimes it'll be a fake out, retest once, retest twice. And these are just more opportunities to enter. As long as we don't break back outside the range, it's just another opportunity to enter and take advantage of the move. And as for targets, simply back to the high of the range, and also focusing on the 50% of the range. You can do this quite easily just by using the Fibonacci tool. Get the Fibonacci out, start from the low to the high of the range, and then wherever the 50 is, mark it with a line like so, and you can delete the fib, and that's the 50% of the range. Reason why I'm talking about this is because normally the 50% is where we do see the most fluctuation. So sometimes the market will respect the low of the range, come come to the 50, fluctuate, maybe push up, come back down again, back to your entry price. So it might not always get all the way to the high of the range, which is why it's a good idea to secure some profits at the 50%, 20, 30, 40, 50%, whatever you want to secure. But it's a good idea to manage the trade at this level, because there's a fair chance the market could come back to your entry, retest level, and then make the bigger swing to the high of the range. Sometimes it would just break straight through, of course. But in terms of managing the trade and making sure you're taking your profits, I would recommend looking to take some partials, or even actually close the trade at the 50%. Very, very high probability for the market to respect the low, come to the high, come to the 50%, and just take the profit. That move in itself is a very high probable move. Obviously, twice the probability of getting to the high of the range. You know, just generic maths there. So yeah, that's what I'll be focusing on, just looking at the highs and lows of the range, waiting for the fake outs. Again, we don't predict fake outs, they just happen. I'm sure maybe there's some strategies out there that predict fake outs, but for me, I'm just mapping out the high and low of the range, waiting for the fake out to happen, and if it does happen, looking for the retest and then getting in on the move. And we've got some clear targets to work with, the 50% of the fib and the high or the low of the range, depending which way you're trading. So hopefully that made sense. We'll get into some real life market conditions and some real life examples, just to show you how it actually works in the live markets. But yeah, like I said, on Euro AUD and Pound NZD, we'll get to it now. Okay, so welcome to Pound NZD. So as you can see, we've got a ranging market here. We've got the high of the range trading around here, and we've got the low of the range trading around these prices here. So like I said, clear range, high and low. You can see the market is, again, not textbook range. We're not seeing clean swings like so. It's more very, very corrective price action. The market kind of slowly bleeds over and then slowly pushes back up again. It overall is a sideways market, but it's not very textbook, and this is what throws a lot of people off looking to get involved in the minor swings, you know, in these areas here where it's a lot harder to predict you know, the exact kind of move back up again, the exact swing back down. You're best off just focusing on the highs and lows and trading in and around those prices. But anyway, taking advantage of these moves. So you can see, for example, this here, this is our high and our low. You know, these are the fake outs of price of the higher of the range. These are the fake outs, and we've got a really big fake out all the way down here. Again, we're not too bothered where price goes. Some people be focusing on that, but I'm just focusing on the low and the high of the range. That's all it is, and these are my fake outs. So you've got the high over there, the low. The market comes, respects the low, comes up to the high, fakes the high. Now this is where it becomes interesting. If we can break back inside the range and retest it, those will look for some clean sell opportunities. So if you can see here, we came into the high, broke back below, retested, and this is where you want to be looking for your entries. You can drop to lower time frames to maximize your risk rewards. Again, I do have videos about entries, so feel free to go and check it out in my Forex education playlist. But this is where we want to be entering the market. Let me change the color again just to make it bit more clearer. This is where we're going to be entering the market. And again, if you do our lovely 50% of the range technique, coming into that level there, you can see the market didn't actually even quite make it to the 50%. So that's why it's important to make sure you do take profit, because sometimes the market won't even get to the 50. Sometimes it will just see a nice reaction and then go against you and then, yeah, take you out your trade. But it's cool, manage to trade, break even, we'll look to enter again. But as you can see, this is a nice move there, probably caught maybe 100, 200 pips on that move there, and then the market reversed. Then we had another big move to the upside. The market broke above the resistance. This time didn't actually give an entry to get back into the trade until this spike there. Again, probably difficult to catch, but it did come back to retest the range there after the fake out. So this time over here, you can see it did it straight away, broke, retest, and came back down. However, this time over here, we had the fake out there, the market came back underneath and then eventually then retested it. This is a common pattern as well. So it might not do it all the time. This is where maybe breakouts and taking the breakouts will work better, but I'm never really a big advocate of taking breakouts. So I always wait for the retest after, which would have come much later. Again, this huge breakout to the downside of the low of the range, and then again you can see the market came back, retested there. You can look for your entries on the retest of that level, stop loss underneath the zone. Doesn't need to be all the way underneath there, no point in that. If the market breaks back underneath this level, it most likely will come to those lows anyway, so you're better off just scratching that and just looking for the retest to go short. So stop loss underneath the zone, and then you can take advantage of a move. Again, if you do use the 50%, which is this zone here, clear move into the 50%, you can see the market is fluctuating around this area. Again, it does respect it to some extent. It's not necessarily a level that you want to buy and sell from, but it's just an area that the market will start to see some reactions and be a little bit more sensitive towards. So it's a good place to take some partials, and eventually it broke through and then pushed to the high of the range, and eventually the market had a breakout. But again, focusing on these areas here will give you high probable opportunities. And number two as well, which is probably the most important benefit of using this pattern, is they don't have to waste your time in here. You know, the market is very, very choppy. It's difficult to kind of navigate and let other people, you know, do the hard work in here. Just focus on the highs and lows of the range. Very, very clear opportunities. You know, you're looking for sells here, so you're not trying to do anything too fancy. You know, you're looking for buys down here. Again, not looking to do anything too fancy. Just wait for the opportunities to come, and when they come, we can take advantage of them. We also had a bit of a ranging market here on pound NZD as well. You can see here the low of the range, faked it. Again, a lot of people would have got their entries here coming to the low of the range of that prior low. They would have, if they held the trade, would have eventually got taken out with a loss, and then that's when we get the fake out and the market then continues higher. Again, with this push here, it does come to the high of the range, and you can see it takes out that high there, comes back down, retest it, nice move to the downside. This didn't quite get to the level there, but again, doesn't really matter. People holding this trade, as long as you're taking profit at the 50%, you know, you should still walk away for profit. If you're being a little bit stubborn and trying to hold all the way to the top of the range, that's when you could pay the price of being a little bit too stubborn there and a little bit too greedy. You know, take what the market is giving you, especially in the ranging market where the market can reverse at any point. You can see here the market came into the level, bit of a fake out, just about taking out those highs down the left. Came back down, retest. This is your trade entry here. Take advantage of the retest. Again, drop to low time frames. I do have videos on that in my Forex education playlist. And eventually the market does eventually make it way down to the low of the range, but you can see how much it fluctuates. So it's a good idea to take your profit at the 50. If it does come back and take you out, break even, say that takes you out, you know, at least you're taking the profit there, and then it eventually does. But again, that's the thing with choppy markets. You know, they're not easy to predict the exact swings, which is why I focus on the lows and the highs of the range. But again, just focus on the lows and the highs. If I just map that and take that across as well, you can see a few more fake outs here, retest. Again, take that across back to the high of the range. You can see all these minor swings and minor swings of highs and lows. It's just very, very difficult to navigate, and this is where I personally lost a lot of money trying to work out these swings here. It's better just to focus on the high and the low of the range. But we're going to take a look at Euro AUD for one more example as well. Okay, so on to our final example on Euro AUD. As you can see, this one was actually ranging quite recently. Big range here. The market's finally actually broken through that to the upside. And again, focusing on the highs and the low of the range here. Again, these are the lows here. To be fair, quite perfect retest of the low, and as you can see, if you focus on the high of the range, we had a really nice fake out. I think it was earlier this week or maybe last week, actually. I think last week potentially. We had that fake to the upside. The market came back, had a beautiful retest over here. As you can see, actually came back and again for another retest. Again, like I showed you on the diagram I drew, the market sometimes comes and give you a couple of retests, especially in, you know, ranging markets because of the fluctuation. We came back and retested, and again, nice move to the downside. If we do whip out the old Fibonacci to mark up the high and the low and the 50%, as you can see, if I mark on the 50, just about there, you can see the market came into this area, respected that area, and then eventually actually ran to the upside and had the breakout. So again, that's why it's important to make sure you do take profit at the 50, because more often than not, you know, the market does fluctuate. Not all the time you see the market just run off and have the breakout, of course, but this is the area where the market will be sensitive towards. You can see if we look to the left, market respecting this area, a lot of fluctuation, respecting that area, fluctuation. So again, this 50% level is not necessarily a good level to buy and sell from, because it's not really a valid support level. Obviously now, you know, this would be a support level because the market's held that region there, but before it's just the 50% of a range. So it's a good level to buy towards and take profit at, but not buy and sell from. So very, very important difference. But again, this is where you want to take your entries on the retest after the fake out. Because again, a lot of people will be getting involved here, you know, shorting at the high, and then this will be the big move that takes their stops. Their stop losses will just be above here, and again, people on the lower time frames taking the breakout will be buying here as well, just be caught on the wrong side of the market. Market comes back in, retest the high of the range, retest the zone, again, keeping it as a zone, not a specific price point, and then we get a nice sell-off to the downside. So hopefully this made sense to you guys. Again, I do have more videos on choppy markets and trending markets as well. Check out the Forex education playlist. But yeah, guys, hopefully that has all made sense today. Right, guys, that is the end of the video. I hope you have enjoyed that and found that useful. Any questions, anything you want to ask me, just drop it down in the comments and I'll be sure to reply to you. If you have enjoyed the video, please do like the video, subscribe if you haven't done it already. It does really help out the channel, and also hit the bell so you don't miss out on any uploads in the future. But thank you so much for watching the video, guys. Take care, and I'll catch you all in the next one.